Welcome into More Than Mortgage. I'm Chad Anderson. That guy there is Zach Jones. And today, this is a topic comes up literally every single closing. So we thought, good time of year to talk about it. Good time to go over it. Purchase market picked up a little bit. Seen more closings, I think, and more activity. Summer has something to do with it. Rates trending a little bit in the right direction. But that is the wonderful world of escrows. So we talk about property taxes, we talk about homeowners insurance. What are prepaids and what is an escrow account? So Zach, I'm sure, how often do you get this? Is it every single transaction? Is it 50%? Because I think for me, it's 100% of the transactions, but sometimes, you know how humans are, we don't ask questions on something we don't always know about because we're afraid we'll look stupid.
Yep.
So I think when people don't ask, a lot of times it's more that than anything. But you get this one all the time, I'm sure.
Yeah, I would add to that the people think, well, I'll just trust you on that. It's they don't want to try to learn about something new because everything else is going on when you're buying a house.
Right.
And yeah, honestly, it was either yesterday or day before yesterday. My wife trolls in, waving papers in my face because we're changing insurance on some properties.
Here we go.
And she's like, I don't understand this escrow. Are we going to have a shortage or an overage? And there's an offshore customer service person at the mortgage company who's talking about stuff, and it's like, okay, so let's just hang up on her, and let me tell you, we'll go to escrow school. The first thing that I would say about this is a lot of people don't even know what escrows are because there's different definitions for escrow in different parts of the country. And since we have so many California transplants and they're used to a house being in escrow when it's under contract, and that's not a term that we actually use here in Tennessee, escrows are very simply savings accounts to pay your insurance and your property taxes. So that's 101, right? The easiest level.
So I personally hate escrow accounts because they really just cause confusion. They really do. Nobody understands how they work. The math is wonky. It makes sense once you can wrap your head around it, but it's just not easy. And the mortgage world a lot of times isn't. But when you're dealing with property taxes and homeowners insurance, it's just very, very strange. Now, in some cases, if, like, for example, if you have an FHA loan, you have no choice. You have to escrow. They require you to escrow. So it is what it is. Now, conventional loans, you don't have to escrow. Zach and I actually work on a model where you can waive your escrows, meaning you can pay them yourselves once a year whenever the bill comes out and comes due. And you can do that all the way up to 97% loan to value. Every other mortgage company I've seen or heard of, I'm not saying they can't, but what I have seen specifically, you can't waive escrows unless you put 20% down, unless you're in California. But you can't do it unless you're 20% down. And if you do waive escrows, they charge you for it. They charge you 0.25% of the loan amount. So $300,000 loan, you pay an extra $750 just to not escrow, which seems crazy. So we actually have this cool little secret where you don't have to, even if you're putting 3% down. We also can do it when on a VA loan. So if you have a VA loan, you don't have to pay escrow, taxes and insurance through us. You can pay it when the bill comes due.
And there's no charge for that. There's no charge for that. That's a dirty little secret. Most mortgage people don't even know that there's no charge for that, but there's no charge for that. Did I say it enough?
One more time. One more time.
There's no charge for escrow waivers if you're working with the right company.
That's right. So what's cool about all that is, and by the way, other mortgage companies who want to try and throw us under the bus and say we can't do that, you're more than welcome to come work here so that you can see, or you know what, just come over. I'll set you up, show you a file, black out all the names and everything, or send you the guidelines, whatever you want. But it is true. It can happen. We've had people try to discredit us, which is a polite way of calling me a liar, saying that we can't do something. We actually can. You shouldn't say something unless you work there or know for a fact. So that's the whole escrow thing. Now, I prefer, again, paying it myself. The reason is, and people say, well, I just want one payment into my mortgage account. Okay, I get it. But what's the difference in making your mortgage payment and then figuring out what your taxes and your insurance are on a monthly basis and just putting that in a savings account?
Mhm.
It's actually better for you because you'll gain a little bit on the yield from the
A
savings.
little bit,
But,
a little bit.
yeah, the biggest thing about that is you have to be disciplined enough not to want to go spend it. And then you're short and you're borrowing from yourself. Like that's literally the only reason you should, you know, if you just can't help yourself, okay, then escrow. But if you can have some discipline, you just shouldn't do it. I mean, do you have another reason? Am I missing anything there?
Well, my mind always goes to this. We're fooling ourselves, Chad, as a country, as a culture. We like to fool ourselves. So it's easier if we pay our income taxes in a withholding every month out of our paycheck than it is to stroke a check at the end of the year, even if we've saved it. And I think that the same is true in escrows, is that at least one of those bills, and usually the largest, which is your county and city property taxes, is going to come due about the same time that Santa Claus arrives, and nobody wants to pay a big old fat bill on the heels of the holiday spending. So it's putting our escrows in the monthly payment is an undisciplined way to save, and it's also a way to kind of pretend like it's all happening by magic behind the scenes. I think that those two things are at play.
So I want to talk about two things here. One of those is the prepaids when you buy a house. So people say, okay, my closing costs, here's the sheet. We're going over all the numbers. Two items fall into the prepaid bucket when you buy a home. Okay. It is the first year of homeowners insurance. Now, whether you escrow or not, you have to pay the first year of homeowners insurance upfront at the closing table.
Right.
That makes sure. So let's just say you close on July 31st of 2024. You have to pay insurance for a year. Now you're covered until July 30th of 2025. And then the bill will be due July 31st, 2025. Simple, right? People then say, well, yeah, got it. Why do we have to now establish an escrow account? I just paid you my insurance. Let's think forward. Okay. Let's think a year ahead. If you don't pay in monthly to your escrow account through the mortgage, then when the bill comes due next year, how is the mortgage company going to pay the insurance bill?
We got to save. That's why it's a savings account.
Where does the money come from?
Yeah.
It comes from all your payments throughout the year that lead up to it. So that's why you prepay at the beginning and then you pay monthly. The monthly is just going ahead and paying for the second year in advance, because insurance doesn't let you pay in arrears. Because if you did that, then all of a sudden everybody'd be like, I'm good on the insurance. Oh, by the way, we just had a fire. Gonna need let me back pay the insurance so that I can now make a claim. Can't do that. Taxes are paid in arrears. Insurance has to be prepaid. That's why they set it up that way, so that pay each month, come around the clock. It's set up, money's in the account, you're good to go. Anything I missed on that? Like, or how do you explain it? Because we all have our different tones and analogies and articulations, but how do you go about that?
I still use exactly the same thing and use the savings account. We're going to make sure that the house is insured for a year, and then we're going to start putting 1/12 of the annual premium in the savings account every month, so that when the bill comes due at the end of the year, at the renewal period, we have enough money to pay it again. Same way you would do it in your own savings account if you were saving on a monthly basis.
Yep, exactly. So that explains prepaids and insurance on the escrow side. Let's talk about prepaid interest real quick. If you close on, well, let's see, interest is also paid in arrears. So think of it this way. I hope you have a better way. I always stumble on this one. Like, I understand how this works, but articulating is a little struggle.
You're already stumbling, Chad.
I'm already like overthinking it. Yeah. I'm way out there, man. All right. So when you make your August mortgage payment, you have a portion that goes to principal. You have a portion that goes to interest. The principal portion is August principal. The interest portion is July's interest. Okay. That's how it works. Monthly payment made, the principal portion is for that month. The interest portion is for the previous month. Okay.
Mhm.
Now, you've all heard, or maybe not, first time home buyers, or just don't remember. If you close a loan, let's say August 15th, well, your first payment is not due until October 1. You actually skip a month in payment. So when you make that mortgage payment October 1, part of it goes to October's principal. The other part goes to September's interest. Now you're made whole. But what happens from August 15 to August 31? Interest accrues because you own the home. You're responsible for the interest payment. You pay that at closing. It's prepaid upfront, collected at closing for the 15th through the 31st. So then people immediately say, well, I only want to close on the 31st then, so it's just one day. There's nothing wrong with that. But you can't see the forest for the trees in that thinking, because you also don't own the house for 15 days in that scenario. So interest is only being charged based on how long you own the home. So if you close at the beginning of a month, it's a huge bill. If you close at the end of the month, it's a smaller bill, but it changes from owning the home for longer to owning the home for shorter. That's the best I can do on that one. Zach, your turn.
Essentially, as soon as you start borrowing the money, you're paying interest on it. And so that goes from day one. And if you close a little earlier in the month, there's some interest due at closing because you're prepaying the interest for borrowing the money for the remaining days in the month after closing. It's really pretty simple, but you're still going to have that month skip before your first payment. So it's kind of interesting, if you wanted to close, I've got a closing on the 2nd of August, and that person's closing costs went up. They had to do that because they were in multiple offers and trying to, get the bid on the house. And so they promoted a short closing. The seller bid on that. And then their closing costs went up and said, wait a minute. I wasn't prepared for all that. And I said, well, you bought the house earlier in the month. And so, if we'd bought it at the end of the month, you would have less due at closing, but you also don't get to live there. Well, I want to have the lowest amount of interest possible. Well, the only way to really do that, Chad, is to never buy the house, right? So as soon as you buy the house, you're going to pay some interest on it.
Yeah,
really pretty simple.
Here's the other thing I remind people of: if you are, the true American way, prolong the debt, right? Is when you buy a home and your payment is due October 1st, in the example we gave, you actually have 15 days to make the payment with no penalty. There's a grace period. Yeah. So the bill is going to come out on September the 16th, and it'll be sent out in the mail or, through your email or whatever. It'll say due on the 1st, but you've got until the 15th to pay it. So it's really only when you get beyond the 15th, there's a late penalty. Usually it's about 4% of the payment is a fee that gets tacked on. It's when you go past the 30-day mark that it affects your credit. Some people don't realize that. Like after the 15th, doesn't impact your credit. You just have to pay a fee. So really each month, like if you closed on August 1, you don't have a mortgage payment due without penalty until October 15th. 75 days of no payment. So another way to look at that. Last thing, I'm going to let you lead off with this one, Zach. Establishing and figuring out how many months of property taxes go into an escrow account, because it changes depending on the time of year.
This is a tricky one, Chad. And I start by explaining that taxes are weird because the government's in charge, right? And taxes are actually due over a 4-month period, at least in Tennessee, one time per year. Other states do things differently with 2 times a year where taxes are due. And that gets really wacky and really hard to reconcile. But in Tennessee, they become due, November 1, October 31st, and then they're not overdue until February 28th or 29th in a leap year. So Usually, most mortgage companies who are managing escrow accounts intend to pay that note or what the taxes that are due in December, sometime in December, around the middle of December is usually kind of when they go out, 15th or 18th or whatever. So this time of year, if you're purchasing a home, one of the important basics to understand is that when you become the owner of the home, you become responsible for the property taxes for that year in which the taxes are due. So as the owner of record, you're responsible to pay them. On a typical resale, which is a house that's previously been owned by another owner, and they're a private individual and they're selling it to you, not new construction, that seller is going to give you a credit at closing for the amount of taxes that are due prorated based on the amount of time that they own the property in that year. So if you think about, somebody selling a property on June, the last day of June, then you're going to get a 6-month credit for them.
Yeah.
But we're going to be collecting probably 10 or 11 months worth of taxes from you at closing, because we have to have enough in that account to pay the bills when the bills are due. Remember, escrow is a savings account to pay the bills when the bills are due, and that's going to come in one lump sum. You close in the end of June, we're going to pick up 10 months because your first payment is not going to be due until June, July, August 1. So if we collected 10 months in August 1, you started making deposits into that account. I may not be explaining this clearly, but you've got August, September, October, and now you have 12 or 13 months in that account. We always have to have a little cushion in there too. And there's the aggregate adjustment that mucks that up. So we're always going to over collect by a couple of months of cushion, because that's what we're regulated to do, so that there's plenty enough in case there's an adjustment in that account. So it is confusing, but I typically on a resale advise my clients that we're going to collect about 3 months worth of taxes at closing over into the prepaid category, which just adds to your closing costs. It's going to be somewhere between 2 and 3 once you do these regulatory adjustments. But the bulk of that is going to come from the seller. Now, game changes if you're buying new construction, because the builder is going to give you only a very small credit for the actual lot taxes of the unimproved dirt that they feel like they're responsible for, and then you're going to get pegged for the full, whatever's due, whatever time of the year that you're closing, for the improved taxes, which is a projected tax amount. So that's one of the ways that a new construction home is more expensive to buy. There are other benefits, obviously, to buying new construction, but that's one of those surprises that can hit pretty hard, especially because a lot of builders end their fiscal year in September, right before taxes are due. So they push for lots of closings before their fiscal year end, which pushes a lot of tax burden onto their home buyers.
Now, remember though, and just to piggyback on that, because Zach's 100% right, sometimes, and this happens a lot in Tennessee, we're going through this right now, the county has already assessed or evaluated the property. Like, they've been out, the number is set. And what happens from a mortgage perspective? So think about this. You could close in August and you could still end up paying taxes as if it's just land, because there's no way for the county to go back and assess every single closing in a short window. So sometimes you could live in a brand new house in August, December rolls around and the tax bill is only a few $100s because it's just for the lot. That's it. They don't know that there's a house there. Now it'll catch back up because the following year they're going to know it. It'll get reassessed and you'll have a normal bill. So this is where it gets tricky, though. I'm really diving deep into the weeds before we finish, is that you go in and you collect, because the mortgage company qualifies you on the fully taxed amount, because they know it's coming. They know it's coming. They got to make sure you can pay the bill. They qualify you on that. Well, then all of a sudden you've got this massive escrow account in December. Well, the person in servicing isn't the underwriter. So the person in servicing gets a tax bill. This is only $380. Let me look at the escrow account. It's $4,000 in here. All right, we're going to pay the bill. We're going to keep 2 months of pad, which is only going to be about $150 or so, $100. And then we're going to send the rest of the money back to the homeowner. You get a check and you're like,
payday.
What was his name? What was the guy that always did like the sweepstakes at your front door? You know,
Yeah,
like that
Ed
guy
McMahon.
yeah, Ed McMahon showing up at the front door. I kept thinking Dick Clark. Ed McMahon shows up at the front door with a big old check, and you're like, honey, we just got a $3,000 check back. We're going to the mountains for the weekend. We're going to Disney World, or we're going to whatever. This is great. The problem is they're refunding you, and now your payment hasn't been adjusted because the most recent bill shows land. So you keep paying the small amount over and over and over. Next year, the bill comes due. Yes, that same escrow person's going, uh-oh.
Wait a minute.
Uh-oh. We're short $4,000. Hi, homeowner. Hope you didn't spend that money. We need $4,000 from you. Now you have a shortage. You owe the bill, or you have to increase your mortgage payment rapidly to catch up on all the taxes and for the future bill.
So you want a little tip to overcome that, Chad?
Sure.
Pay attention to your mortgage person who says that this is what your obligation is actually going to be. Whether or not it turns out that way with the escrow reconciliation, the servicing person and the closing company and all that stuff, we're going to accurately convey those things to you. And so if I tell you that you've got a $3,700 a month payment and you wind up having a $3,100 a month payment next year after the escrow reconciliation, they're wrong. I'm right. It's coming. It's coming. Just brace yourself.
Yeah. So just a little word to the wise. That's another reason, especially on new construction, is don't escrow. Pay it yourself. You can always decide later, call your mortgage company. Hey, I want to escrow now. They'll let you establish one, but that's especially on new construction. Just don't escrow. Just do it yourself. Right. That eliminates a lot of the confusion because then you just pay the bill whenever it comes due. You don't have to worry about the analysis and the shortage and the overage and all that other stuff. So I'm sure we confused the hell out of you. Anything to finish up, Zach, on all of that?
Well, I would like to just add this little nuance here to this whole discussion because we're in a bit of a unique situation in Tennessee with regard to property taxes. A lot of states in the nation, their county property taxes will reset at the sales price at the transaction time. We see that in California. We see that in Illinois. A lot of states have that mandated. So if somebody is selling a $250,000 house that they bought 12 years ago and now it's $1 million, then your new taxes are going to be assessed at that $1 million value. In Tennessee, we reassess property values every 4 years. And the further you get away from the initial establishment of taxes, the further that value from the tax assessor's office lags behind the actual market value. So we've got a lot of advantages to property taxes in the state of Tennessee because effectively, when you buy a house from an existing homeowner, you inherit their tax rate that they enjoyed for the last however many years since the most recent assessment. So it's not uncommon at all to see, say a $750,000 house be assessed for $317,000. And you're actually paying property taxes on $317,000. If you go down and buy a new construction house at $750,000, then you're going to be taxed at $750,000 because that's the established value per the only record on record of what the value actually is, which is the purchase price of a newly constructed home. So some pretty significant advantages if you live in a state that only has periodic tax assessments instead of that reset at every transaction.
Yeah. Every state's going to have its own little quirks, like Zach was saying too, on when the bill is due, how it's assessed, when it's assessed. Alabama, for example, has homestead and non-homestead, which basically means if you own an investment property, you get taxed double. But I'll say this, people who move in here, they can't believe how cheap the property tax is compared to where they're coming from, such as Illinois, California, New York. Some of those places have outrageous property taxes, significantly
Florida.
cheaper here. Yeah, even Florida's high. Yeah, Florida offsets, they have the no state income tax, but yeah, their property tax and homeowners insurance very high. Costs a lot to maintain property there. You and I know about that. All right, that'll do it. So escrows, at the end of the day, you probably aren't going to learn all of this just from the 25 minutes on here of us bantering. So give us a call, follow us on social media at Zach Jones Loans, at This Chat Is Real, everything up here in the corner, but we can go over it with you again. The biggest thing too is we don't require the escrow up to 97% of the loan amount, which is a huge victory over a lot of other situations. So keep that in mind as well. All right, guys, have a good one. For Zach, I'm Chad. We'll catch you next week.